Welcome back to the channel, Crypto Trend Trader, with an update on Bitcoin. Before we get started, I'd like to remind you it's not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Today we're looking at a blank chart, and we're going to actually do something a little different. We are going to talk about the importance of determining a long-term uptrend versus long-term downtrend, and the difference between dollar cost averaging down and dollar cost averaging up, and essentially trying to pick the bottom versus pick the top, and the importance of all these things, and the importance of where we invest our limited resources, and the importance of not only price action, but also like the value of money and the cost associated with it being tied up in an asset that's not doing what you need it to do. So we're going to just start off with the basics. The most important thing right off the bat, I'm going to just use the Elliott Impulse Wave tool, and we're just going to draw just a basic uptrend. And it's very simple. There's not much to it. It should be very well easily identifiable. We're starting down here at a low value. We come up to a higher value. We come back down and we find a higher low from the initial point. And then we come up and we put in a higher high. And then we come back down, we put in a higher low once again. And oftentimes when we put in this higher low in a 5-wave structure, it's going to find support on the 1. So you'll see the 4 will come down to the 1, find support, and then we'll move back up from there. And that's essentially just a long-term uptrend, and pretty basic, obviously. And now let's talk about the difference of a completely different asset, let's say, and let's look at a long-term downtrend. And we're just going to use essentially like our same points of contact on the chart. The actual dollar values are completely irrelevant. But all we're going for essentially is the determination of essentially like whether or not this asset is strong, whether or not it's moving to the upside or downside, and whether or not it's a good investment. So essentially in this case, we have a high, and then we come down, we put in a low, and then we get a relief rally, and we put in a lower high. It's lower than the initial point, and then we come down again and sell off, and this time we put in a lower low, and then we're going to come back up, and this time we put in a lower high than the previous two highs. And again, often you'll find that the previous support when we were coming down will act as the resistance, and then again we sell back off, and then that's our bottom here for this example. Now the importance of this now is to determine overall on a long-term time frame whether or not you want your money in this asset. So the idea with the long-term uptrend is what you want to do is you want to be in this asset because over time, the longer you're in this asset for, the more valuable it is. It's going up and to the right. And in a downtrend, the opposite is the case. The longer you're in this asset for, the lower the price goes. So you want limited exposure in a downtrend and you want maximum exposure in an uptrend. Okay? But because things don't just go up in a straight line, they tend to do, obviously like the stair step action. What's important is, in order to maximize your gains in a situation like that, you want to basically take profits at various areas so that when you take your profits along the way, you can lock those in and then you don't have to eat the retracement. So in this case, if we were to just buy right here at, let's say just 0, and then it went up to 50 cents, we've gone up and we've made 50 cents. But the idea being that if you were to ride this portion of the wave up, but then you were going to skip out on this, you took profits at the top area right here, the price goes back down, and then what happens after that? You're going to rebuy again, and when you rebuy this time, you're going to buy near the bottom. Obviously, you're not going to catch the bottom on every single move. That's unrealistic, but it doesn't mean that you can't sell and take profits in an area, wait for a retracement, and then buy back more of that asset. Because it's a lower price, you're able to get more with nothing else changing. So if everything else stays the same, but the price is lower, you can buy more of it for the same amount of money. So now what we're looking at is essentially if we bought right here and then we took profits at the top and we did not get wrecked right here, we did not take that loss down here, we then buy again at the bottom, and then we ride it up to the third wave, and then same thing again. And now again, this is unrealistic that we would be able to buy the bottom on all these situations. But now we can see that here we were at basically the bottom at 15 cents here, and at the top we were at 50 cents. But now by avoiding the dumps, we can now take this and we would just put it right there, and then we would take this one and we would put it right there, and you'll see that by riding the exact same wave but without taking the downturns into effect, instead of essentially having 50 cents now in value of this asset. However much, say we had one share or one crypto and it was 15 cents and now it's 50 cents, we made 35 cents. But if we bought right here and we sold the bottom every time, which again is unrealistic, but if we bought at 15 cents and then we rebought down here, that would mean that we would have more of that asset. So we would get all the gains from here, none of the losses, and then our next set of gains gets stacked up on top of the previous one. So now we have our 3 stack of gains, and now you'll see we're at 70 cents. So essentially, we made an additional large percentage in this situation, almost another 50% over the total top value here. Okay, now again, it's not realistic to think you're going to do that in all those cases, but if you can even mitigate a small portion of that risk, in the end, it adds up. So essentially, if you didn't sell the absolute top, let's say you sold right here, and then we did the exact same thing again, but this time we rebought and we didn't buy the absolute bottom, but we were able essentially to capture this additional gain by not losing. So by selling here, as soon as we confirm that we're losing our uptrend and we're going to come back down for a retrace, we can be out of the trade. And then at some point in time, anywhere when it's lower, as long as you're in a confirmed uptrend, you figure at some point in time it's going to go back up. So you want to buy back in as it goes down. So you want to buy back in, you buy back in here, and then again, you ride it back up to the top. And the same exact situation. When you start getting near the top here, maybe you don't sell the absolute top, or you start taking profits along the way. So you don't capture that little bit right there, but you also avoid this downturn right here. So now you've avoided this loss right here. You've avoided this loss right here. So the idea being is that by not taking these losses here, it's the same thing as just making more gains. So even though you didn't actually make more gains because the price was going down, you didn't short it, but because you weren't long on that asset, you also didn't lose. So now you can take that same amount of money. If we sold right here all of our shares or whatever and we had $20, okay, and that $20 was the equivalence of, let's just say $1 a share to be even, like just simple. If that was a $20 worth of an investment and we sold it right here, it was worth $20 and we had 20 shares, each share is worth $1. If we go back down and then it goes down to say 75 cents a share, if we use that same $20 to rebuy, now we don't get 20, we get more because it's only worth 0.75. So now we're going to get 25 shares. So now we have 25 shares right here. So even the value isn't as high right here as it was. The amount of the asset we have more of. So even though the asset is worth less, we now have the same amount of money because we use the same money we had right here to rebuy the asset cheaper. And then when we capture the next move now, if we would have just rode this whole thing up here and we rode it to 20 here and then we took the way down, we had to get all the way back to 20 and now we're back at 20, $1 a share. Okay, and then we ride it up again and let's say it goes up another $20. Now we have 40, $40 worth. We have 20 shares at $2 a share, let's say right here. This is $1, that's $2, okay? Now, in this case, when we rebought here at 25 and then it goes back up here, now we capture this move up here from the 25 back up to here. So when we get back to here, each share then becomes worth $1. And now we have that 25 shares. So now we're at $25. So then we capture that additional gains here. So here we had $20 that's going to keep going up. And now here we have the 25 that's going to keep going up. So you're going to have exponential gains on this. We're going to have more than if we just rode this straight up here. And it was worth 20, came back down to 10, and then went back up to 40. So now we still have the same amount. We still have $40 worth. But here we rode it up to 20. Didn't eat the loss on the back down and then bought back at 25. So then when it doubles this time, we have 50 now. So here we had 40 if we rode it straight up, and we have 50 if we were able to get back out of the market and then rebuy cheaper. So the idea over time is that you want to get out of the market for the retracements, but the majority of the time the asset's going up. So you want higher exposure. You want maximum exposure. But the idea is that you limit your exposure to the retracements, which are the smaller portion of the trend. Okay, and that's an uptrend. And now in a downtrend, the exact opposite is the case. In a downtrend, the price is always going down consistently over time. So now let's say we got all the way up here, and let's say this was 20, that was 40, this is 60. So now here we are at $60, and you own, let's say one of this asset at $60. If it drops down to our 40 point right here, you are going to have lost 33% of its value because now it's only worth 40. But if it drops down even further, and let's say this is the 30 zone, or no, I'm sorry, the 20 zone. So now we went all the way down to 20, and it was worth 60, you lost 66% of your value. But then when it bounced back up here, now you're only down 50%. I'm sorry, what was it? 33%, because you had 60 and then it went down to 40. All right, so as long as you don't sell, it bounced back up. So you're like, okay, it's back at 40. That's not bad. And then it goes down again, and you're like, oh no, it's all the way back down at 10 now. And then it bounces back up, and then you get to 20. So along the way, essentially, the more exposure you have in this market on a downtrend, the more money you're going to lose, because it's consistently going down over time. So the idea being that if you want to trade a downtrend without shorting, all you want to do is you want to sell as it's going down and then rebuy once it's found support. So if you had $60, one share right here, one crypto or whatever, and it's worth $60, and then it sells back off down to here, and you eat that whole move, and it goes down to 20, you just lost 66% of your value. But if you had one here at 60 and you sold it and got out of the market and said, okay, I'm selling it, it's a downtrend, I'm going to just take my $60 and we'll see what happens. And then it drops back down here to 20, and let's say you rebuy at 20 right here, now you have 3 of that asset. So now you have 3 shares or 3 cryptos or whatever. They're only worth $20 each, but you have the same amount of money equivalents as you had here at $60, but you have 3 times as much of the asset. So if you're able to trade that successfully, ideally what you would do is you would sell up here once the trend is topping out. Realizing the trend is topping out, you say, okay, I'm going to get out of this market because we're in a downtrend. It looks like we've topped out. And then when it sells off, you see it start getting near the bottom, and you want to go ahead and rebuy now. So you say, okay, it was $60 here, I sold out, I have $60 now, and now here it is, it's say at $25. So now I can buy 2 full shares and 1 half share. So now instead of having 1 share worth $60, you have 2.5 shares here worth $60, same amount. And then it bounces, goes down, you take a little drawdown, but then it goes back up. And now here it goes back up to 40. So we had it was 60, it went down to 25 a piece. Each one of those 2.5 assets we have now just went up to 40. So we gained another $15 per full asset. So we just gained basically another, $37.50 basically. So we have another $37.50. So now our $60 that we had right here that we rebought with is now worth $97.50. So we're able to ride the wave back up. But the asset itself is actually still worth less. But the idea being is as we see this trend now starting to top out again, we want to get back out of the trade. We don't want to be in this market exposed. So the idea is when it sells back off here, we start topping out or whatever, you're going to sell again and get out of the asset. So now we're going to sell our 2.5 shares here at roughly, $40, just slightly under. And then when it sells back off now, we had 2.5 shares here, but we still have the same amount of money. We still have our $60 worth of money plus our gains from here. So now we have, almost like basically $100 because we have our initial $60 plus we have our $37.50 in profit. So now we have roughly $100. We sell out of this asset right here. And then when it goes back down to the next level, we do the exact same thing again. And we're going to want to rebuy down here. Once we think it's starting to top out or whatever, or bottom out, we rebuy. And now we're going to use our same $100 and we're going to buy. How much can we get at, essentially this is 20. So let's say this is about $15. Now we can get basically 6.5 of that asset. And then all of a sudden it bounces back up to 20. And now that 6.5 of the asset that was worth 15 is now worth 20. And now you essentially have, over $130. So you're making gains on the way down, but you're limiting your exposure greatly on the way down. As opposed to on the way up, you want to have maximum exposure for the majority of the time. So on the way down, you want limited exposure. On the way up, you want maximum exposure. But the idea being is that if you're only buying, because all shorting really is just selling something you don't have. So, we'll just basically, it's just selling, but you're just borrowing it from someone else and then you have to pay them back at some point in time. So all we're doing here is we're just going to pay attention to when we're actually like in this trade and when we're not. So, and then it's going to give us a better idea of like the understanding of why it's important in an uptrend, downtrend, and dollar cost averaging up versus down. So essentially here, we're riding this up for this whole green wave, and then we're out of it for this little bit of red right here. And then we get back in right here, and we ride it up, and then we're out of it for this little bit of red right here. And then we ride it back in, and then we finally sell when it tops out or whatever. And then vice versa. We're in this trade in right here, and then we say it's going to go down, so we're going to get out of the trade. So now we're out of the trade for this whole move right here, and then we're going to rebuy. So we're in the trade for just this little bit, and then it tops out, and we're going to get out of the trade for this whole time right here, and then we're going to rebuy, and then we're going to get in it for just this little bit. and then we're going to get out of the trade for this whole time, and you get the point. So essentially the idea is, in this case, we're in the trade for, let's say, 75% of the time. On a short, we're only in the trade for 25% of the time because we're only taking advantage of the relief rallies to gain profits. Now, if you're shorting, it's just the opposite, but it's the same rule applies. If you're literally shorting right here, you want to be in the short for this whole time. You want to take profits at the bottom here and get out, and then you want to re-short at the top again, and then you take profits on the way out, and then you get back in, and then you take profits on the way out, and you short again. And essentially all it is it's the same exact thing. A short on the way down is the same thing. You're trading with the trend. You're selling because you don't want to be exposed to that asset, and then you're rebuying for the bounces. In the same way that on a way up, you're going up consistently, so you do want exposure the majority of the time long. So you're buying when it's going up, and then you're getting out when it's going down. So essentially trading with the trend, whether it's going up or down, does not necessarily matter. Now the reason it's more important, and I would always rather be long though, is if we're right here and we're say at $1 and then we go up to $60, what happened? We just 60x'd 60 times, okay? But if you're here at $60 and you sell all the way down to $1, you only really went down like 90, whatever it is, 7% or something like that. So in this case, if you shorted this whole way down, you shorted, your short was 97% profit, which is good. You basically doubled your money. That's awesome. But if you bought down here, you 60x your money. Here from $1 to 60, you got 60x. Here from 60 to $1, you didn't even lose 100%. So you're always better off in a long trade because there's always so much more upside potential. Something can only ever go to zero, so it can only ever go down like 99.9%, but it can go up exponentially thousands and thousands and thousands of percents. So you always want to be limited in your exposure to shorts because the likelihood of profit is much less on the way down, even if you're trading with the trend. Now, that's our basics, and that's why it's important to be in an uptrend versus a downtrend. So now if you're not shorting though, and you're doing what we're saying, and you're just rebuying lower and buying more of the asset right here, if you're expecting at some point in time, this is going to go back up, and you're just going to take this drawdown. You're not going to exit any trades. You're just going to hold. What people will do is they'll do what's called dollar cost averaging. So say you bought up here at $60 because you thought it was going to go higher, and it topped out. So then it went down to $40, and you ate it, and you said, okay, it's down to $40 now. So I had one at $60. I'm going to buy one more at $40. So now my average price is what I paid for those two assets divided by the amount of assets I have. So 60 plus 40 is 100 divided by 2, so now it's 50. So I was in at $60 was my break-even price here. It went down, it came back up, and then I rebought again at 40. So now my average price is $50 for two assets, two shares. But if it drops down here again, and then we go back down and we're here at like 20, now we rebuy again. So we bought at 60, we bought at 40, and we bought at 20, and we bought the same amount at each area. So now we're in for 60 for one, we're in for 40 for one, and we're in for 20 for one. So now it's $120 total we had invested, and we took the drawdown the whole way, divided by those three assets. So now we have dollar cost averaged on the way down. We dollar cost averaged down to $40. So now our break-even point is in the middle of these 2 points, as where our break-even point was way up here, but by investing lower, we were able to lower our break-even point to the 50 mark right here, and then by investing again when it came down, we were able to lower our break-even point to the 40 point when it came down here. And that's dollar cost averaging into a downtrend. You're saying, I'm at a loss, I don't want to sell, but eventually it will stop going down, so if I keep buying more as it goes down, I will eventually be able to break even at a lower price. And then you're just excited to get out of the trade without a loss. And that's the worst case. You don't ever want to be in a trade where you're excited to get out of it at a break even because you just didn't lose. Okay, you should have been out of that trade a long time ago. But the problem is, you don't know, is this thing going to stop going down right here, and that's it, unless it's at zero. It could just keep going down, keep going down, keep going down, and you're dollar cost averaging the whole time, and you're buying more and more as it goes down, trying to balance that out, and you're ending up in a worse and worse situation. Better overall, but your initial loss is just getting bigger and bigger and bigger, and then your second entry point, the loss is getting bigger and bigger and bigger, and then the third entry point, your loss is getting bigger and bigger and bigger, and then finally you get in this trade, and then finally it turns around and you make it back to the break even, and all that money was tied up for all that time, and you kept investing in it, and the whole time you were at a loss. So you're consistently just at a loss, but you're trying to mitigate that loss by having a little less of a loss. Now let's talk about the opposite. Let's talk about buying into strength. which is what you should be doing. If you buy right here at 20 and you buy the top, and then you say, oh no, I bought the top, and it starts drawing down and it goes all the way down to 10, and you say, oh man, that was a mistake. I bought at 20 and now it's down to 10, but I think it's going to keep going up. We're in an overall uptrend, so I'm going to go ahead and buy again. So I bought at 20 and then I bought at 10, so now I have 2 shares at 30, so my average price is 15. So now we get back to 15 on the way back up, and now all of a sudden, look, you're break even right here. So then when we get back to your initial investment of 20, you now have 20 and 10, you're in it for 30, you're back at 20, you have 2 shares at 20, so now it's at 40. So now you're up 33% on this trade from your single dollar cost average. So now let's say we keep going up, and then when it gets up here, you make a bad decision, you FOMO in, you buy the top again, but you're confident eventually it's going to stop retracing and you're going to keep going up. So now here you are, you bought at 20, you bought at 10, your average price is 15 for 2 shares. And then here you did it again. You bought at 40 this time, so now you're in at 40, you're in at 20, and you're in at 10. So you're at $60, $70 in this asset right now, okay? So you're in it for 70 bucks, but here we are up at $20, and you're in for 70, and you have 3 shares now, but now the price is only 60. So you actually made a mistake, you know what I mean? You lost, but you didn't lose big, because you're in at 20, you're in at 10, so you're in for 30. You buy again at 40, so you're in for 70 now. So it's 70. You have $70 invested, but the price of those assets, each one is worth 40, and you have 3 of them. So you have $120. So your average price is $70, but you're in for $120. So when this sells back off, if it sells back off to 20, and you have 3 shares, and your average price was 20 and 10, so you're in for 30 right here, and then you bought the top right here for 40, you're in for 70. So you have $70 invested, and then it sells off to $20, and you have 3 shares. You have $60 invested, $70 invested, and the price is 60 bucks for those 3 shares. So you're down, but you're only down a little bit. You're only down 10 on that $70 investment. So you're down like 15%. But then if you buy again while you're down, and you're buying into strength here, even though you bought the top, and then you bought near the bottom, you bought near the top, you bought near the bottom, now you have 4 shares. And your average price is 20 for this one, and 20 for this one, and 10 for this one, and 40 for this one. So now you're in it for 40, you're in it for 80 with that one, and 10 for that one. So now you're in it for 90, and the value is only 20, but you have 4 shares. So you're buying into strength, your dollar cost averaging into an uptrend. So you have $90 invested, but each one is only worth 20, and you own 4, so it's worth 80. So you're still down, but you're confident we're still in an uptrend. We're putting in higher lows and higher highs, so we're going to keep going up. So now here, that $90 investment that's at a $10 loss right here, when you get back above, when you get back up to here at the $40 mark, now you have 4 shares at $40. So now it's worth $160 when it comes back up here. So now you have $160 and you have $90 invested. So you're basically at that point up $70 on your $90 investment. So you're up substantially, and that's just getting back to your break even when you made a bad decision. So essentially, if you're dollar cost averaging into a strength, which is dollar costing up, which people don't like to do. They want a dollar cost down. I want my dollar cost to be as low as I can because it looks like I got in at a lower price, and that's good. But no, that's not good. It's the opposite of good. It's bad. Because if you're dollar costing down, it means you're making a mistake in a downtrend. Now, if you're here at $20 and then you rebuy here at $10, your dollar cost down for sure because you bought at 20 and you bought at 10. So now your dollar cost average is only 15 per share, but you're in it for 30 bucks. That's cool because it's an uptrend. So eventually it's going to go up. So you're dollar costing down into an uptrend. But when you buy the top right here on accident, your dollar cost is up because you're here for 20, you're here for 10. So you're in for 30, and then you buy at 40. So now your 20 and 10 is 30, and your 40. So now you have 70. So you take that 70, you divide it by 3, and that's going to give you your dollar cost average. And your dollar cost average is now higher because here it was 15 for 2 shares, and now it's going to be 70 for 3 shares. So yes, your entry price doesn't look as good. Your dollar cost average price doesn't look as good, but you're in profit consistently the entire time on the way up. And I hope that I broke that down in a way that it's both simple and makes sense, and it's important to know the difference between the uptrend, the downtrend, and when you want market exposure. On an uptrend, you want as much exposure as possible. You can buy the dips still, but even if you buy the absolute top, as long as you don't buy the last absolute top of the whole trend and the whole reversal point of the market, you'll always be in a position where eventually you're going to go back up. But if an asset is consistently going down for a long period of time, you can keep dollar cost averaging into it, and it's never going to bounce back up to the point where you're going to be, to maybe break even or whatever, but you're going to be so excited to just get out of that asset at break even after like months or years or whatever of being in a loss. And that's the last place you ever want to be. So now we're going to look at some assets and I'm going to compare them so we can get an idea. This is Cardano, everybody's favorite crypto. So here we have Cardano, and when we look at this on the shorter time frame, this is a weekly trend. We put in the bottom right here and we're on an uptrend, right? We're going up consistently. We're putting in like a high, a low, a high, a low, a high, a low, but we're putting in higher lows. But we have to zoom out because this is a short-term uptrend. So great. If you're buying into this for the first time and buying into this and buying into this, you're buying in a strength. That's great. But overall, we need to know, is this an uptrend or a downtrend? So we want to zoom way, way out to the absolute longest time frame and see what's going on here. And what is this now? This is a downtrend. Hang on a minute. We zoomed out and all of a sudden it doesn't look nearly as good. We topped out here. We sold off. We came back up to a lower high. We sold off again to a lower low. We came back up again to a lower high. Sold off again. This time we found support, bounced up, but then we sold back off to an even lower low. So it was like a fake out that this was going to be like the beginning of an uptrend. But now here we are. We finally put in the bottom right here, and then we start moving up. But where are we at though? We're still never going to get close to this. Well, I shouldn't say never, but we're still far from close to that. So the last thing you want to do is say, oh, I bought the top, I'll just buy again somewhere else. And then you buy here and then it keeps going down. And then you buy here and then it keeps going down. Keeps going down. Buy here again. Keeps going down. Buy here again. Thinking it's flipping up to an uptrend. Keeps going down. So the whole time you're never going to end up back in profit on this until finally it gets like back up to your break-even point. It's going to be like somewhere up in here. Okay. So this whole time you want to be out of the asset. And then it finally bottoms. You maybe want to be in for that little bit right here. Just that little guy. And then again, you want to be out of the asset. And then there you go. You want to be in for this. So on this whole chart, the only time you want exposure to Cardano ever in your whole life since the beginning of time was the very initial run up, okay, which was clearly like just full on, just FOMO run. So you have this little bit right here, that little FOMO up, all-time high that we'll probably never get back to. And then you have this little bit right here, which is a bullish retracement of the bear sell-off. We're selling off, and then finally there's a relief rally, but we don't even come close to taking out the high. And then people say, oh, thank God, I got to get out of this position because this thing is trash. And then it sells way back down here, and then you rebuy again, and then you're in it for that long, and then what do you want to do? You want to get out as quick as you can, and then it sells back off, and then you can ride it for this little bit, and then it sells back off, and then you can ride it for this little bit. And then what's going to happen next? It's going to sell back off. Is it going to put in a lower low? I don't know, but I have a feeling it's going to come way down. So if it's at 14 cents now, where's the most likely place it's going to come down to? It's going to come back down to our pivot, our previous support zone. So where was our resistance previously that we may find as support? Well, this was resistance here. We topped out. Couldn't get above it. So that's a pretty important area. And then where else do we have resistance at? Well, we couldn't get above this initially. We were able to break through it finally, and when we did, it was a nice move up. And then what happened? We came back down and retested it. SR flip. We broke through it. It was resistance. Found resistance somewhere else at a higher level, and then we found support on that. Did not sell down below that. And then look, we start pushing up again. And now here's our next resistance. And then this time we break through that resistance, and we push on up. And then we're going to top out either where we're at or somewhere near it. Let's say over here. Very close to topping out, it looks like. And then where's it going to go after this? It's going to sell back off. And where do we expect it to try to find support? At our previous resistance. And that's that SR flip. So where's the next target for Cardano, like long term? Probably is about 10 cents. So expect it to lose 40% of its value very soon. And if this doesn't hold, this resistance right here, I think it's going to go down to like 6 or 7 cents. So you can expect it to lose basically from where it's at right now, 50%. Or more if it doesn't find support there. But essentially, when we look at this, it looks like, you see this is potentially, just looking at this little wick right here, looks like that's where it could have topped out. But if we look at this a little more accurately, more realistically, we're probably going to top out at that. That was a very strong support right there, and we got to move up, but we couldn't get back above it. and we topped out again. So these are our like key resistance areas. And where are we at right now? We're at a key resistance area. So this is where you take profits, because all the people that were trapped this whole time, all these people that were trapped in this trade are looking to just get out. They just want to get out of this thing at the best price they can. So when we come up to those resistances and we do like a support resistance flip or a resistance support flip, people are looking to exit those positions. If they're in profit, they're looking to exit because they're in profit and they're expecting a retracement, and then they can buy lower. If they're at a loss, they're looking to exit as soon as they can so they don't take a loss when it goes back down. But overall, consistent downtrend, a high, a lower high, a lower high. You could potentially say that we're putting in our first legitimate higher high. But at this point in time, we could literally have put in this low right here, come up here, and sell back off again to a new low. And then all this is going to look like is this is going to look like swing 1 and then 2 is not going to end right here. It's going to go, this was 1, this was 2 all the way down here, and then this was 3, and then 4 is going to come all the way down here somewhere else. So this is terrible, and we don't want to be exposed to this asset. And the absolute, if you do, you want to be exposed for the least amount of time possible in these little, they're called relief rallies. We're selling off, 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 and you think, God, it's going to 0, and then finally it can't go to 0 anymore. It's somebody's going to buy a little bit. And then it gets this little move here, and then selling off, selling off, selling off, selling off, selling. People say, okay, that's it. We're going to double bottom right here and put in a higher low. I want to be in it. And then selling off, selling off, selling off. Oh, new low. That's terrible. So now let's switch over to something. This one is Tezos. Everybody's familiar with Tezos. And I almost did Chainlink, but I don't want to do Chainlink just because it's a little too crowded right now, in my opinion, that trade. But Tezos is a good chart. Let's look at that. So here we are. It looks the same as Cardano when we were first looking at it, right? We put in a low, high, lower high, or higher low, higher high, higher low, higher high. But we're broken out right now. You know, there's no resistance above us. We're above that. Well, we better zoom out and make sure, right? But there it is. That's it. That's where it started at. That was our initial price. So once we broke through this initial price right here, there was nobody that's at a loss in this asset. As where with Cardano, people were at a loss that whole way down, whole way down, whole way down. So every time it moved back up, people were just trying to get out of that position as best they could, at the best price they could. They just want to get out because that money is just wasted sitting in that asset, just getting wrecked. The last thing you want to do is just keep putting more money into it. You're betting on a loser that one day it's going to turn around. As where with a bullish chart like this, that's on an uptrend, consistently making new highs, let's look at this now. Where do we want exposure to this asset? Well, not here, not from the ICO like on the exchange right here. You know, obviously it got wrecked. You know, it pumped up, probably going up to it, and then gets listed on the exchange and it dumps off. But once we get back up, it looks like we're double topping here, and then we sell back off. Well, why is that double topping? Because this was our initial high. That was the area where if you got into it right here, and then you ate this huge jump, you're just sitting on it, sitting on it, sitting on. Oh, should I sell? Should I sell? Should I sell? Should I sell? Oh, and we're even. And then you get out. Thank God, I'm out of that thing. And then when it comes back down, it starts finding support here, and you say, well, wait a minute. It's finding a higher low. So maybe I want a little exposure. So you start getting back into this thing, and then it starts coming up here, and you say, I better take profits. But I'm still up, but I'm going to take profits because this is a strong resistance area. And then it comes back down, puts in another higher low, and then you say, oh, hang on. I might take a little profits right here, and you'll see we got a wick back down here again, and then it got bought straight up, and what happened? New high, blue sky breakout. And after that happens, you want to wait for the retracement. Once you get a blue sky breakout, you wait for the retracement to come back down and buy support, and then you buy into that asset with strength, and your dollar costing up. So if you were in it from this point right here, or you were in it from this point right here or whatever, yes, your dollar cost average is higher, but you own more of the asset. So yes, you paid a little more for each of it, but now you have more exposure to an asset that's going up. And the best thing to do is have exposure while it's going up. So let's do the same thing we did with Cardano. And all we want to do is we want to be exposed to this asset this whole time. We want to be exposed to the asset this whole time. And finally, we want to be exposed to the asset this whole time. And this whole time is going up, and then there's just a little retracement, correction, going up, retracement, correction, going up. So now let's look, how do you determine when you're going to put strength into these things? Well, obviously, this is a clear and defined, resistance top right here. So we want to pay attention to that, because every time it's going to get back up to that, it's going to sell off. It almost made it here, sells off. Almost made it here, sells off. Almost made it here, sells off. And then finally, that wick gets bought up and it breaks out. So you don't want to necessarily buy right here because you're afraid you're going to buy the top. So you're like, oh, I got to get it now. I'm going to buy in. You buy $3.90 and then it comes all the way down to $1. You lost 75% of your money in the uptrend because you bought the top. So I get it why people don't want to buy if they think it's potentially going to top soon. But what if you thought this was the top, 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 so you never buy into it? That's fine. Wait for the retracement, but know that you're putting in a higher low, so you want exposure to that asset. And then finally, you put in this new high right here on that blue sky breakout, and then what happens? You would expect to come back up to it, and then finally you hit that area, sell off a little bit, and then you break out. Well, now where we're at right now, there's no selling pressure. No one has literally ever bought this asset more expensive than the price it's at now. So every person that ever bought from here all the way down, all the way here, all the way down, all the way here, all the way down, all the way here, if they just held that asset, it's worth more than what they paid for it. So every person that has ever bought Tezos right now that didn't sell it, that didn't take a loss and get out of the asset, all you had to do is buy and hold. So if you want to hodl something, if you want to invest in something that's in an uptrend. And that's exactly what this is. And it's the same exact thing, in any market, any asset, anything. Buy into strength. And even if you make a mistake and you buy the absolute top, as long as you hold and you don't sell and it's in an uptrend, you never lose. The problem is when the market flips and say we topped out right here and then we start going down and we enter a downtrend. And that's why stop losses are important. So you don't just get stuck with a bunch of bags. So now let's look at this again and see, well, how do we know where we're going to buy at? How do we know when it's going to top out at? Well, let's look at our resistance support, because that's what we're looking for, right? We essentially sell back off. This is a strong resistance right here. We come up here, get back to it, and we double top. All right? So when we come back down, we're going to look at where did we find support. We found support right here in this area. Okay? So once we find support, we're going to come back up and find resistance and everything. So then when we find our next breakout, when we come down, we would expect to find support at a higher level. So even though we didn't find support exactly at the top of the previous little peak right here, we still found it higher than the previous support level. And that's what's important. That's the most important thing, is we're consistently putting in higher lows. And you'll see what happened was this is a bullish asset. So when it went up here and then came back down and then topped right there, and then it put in this, and that was confirmed as a higher low, when it came back up and went above it, and then we were able to find support at a higher level, it goes all the way up. People are expecting it to come back down to at least this point to rebuy. But even if you bought there and then took the drawdown, you still eventually get back above it and then your new highs. So what's going to happen eventually is this sells off and finds support at a previous high typically. So when this does top out and it finally sells off, where do you expect it to come back down to? Well, I would say probably somewhere around here. $1.86 is a pretty reasonable target for this. But even if it sells off, as long as the actual trend does not reverse, as long as it's not the end of this whole entire uptrend, you're still in a good position, even if you bought down here, because the likelihood it's going to happen is you're going to put in a higher low and continue up. And worst case scenario, if this thing tops out right here and comes down and we take out that low and you come back down here and you put in a lower high, a lower low, you would still expect at some point in time it's going to come down here and then bounce, and then you can exit your position potentially, still in a win or at least not in a loss. But the idea is that once you break out to a new high, you get a blue sky breakout and it continues. So you got that much continuation. This was the top before, you broke out, you got massive continuation. So this was the top before, we just broke out. So what's likely to happen on this asset? Massive continuation. And what does that really translate to? I mean, let's just take, there's so many ways that you could do this, but let's just go buy from the previous top to this top right here, and then let's just see what that would look like as a target. That would give us a target of basically 556. So that's still, another over, 30% more potential to the upside, with no resistance, because we're in a blue sky breakout. So I don't think that that's unrealistic. Now, is there a better way that you can make these targets? Is there a way that you can predict into the future, what is going to happen, like where is it going to go? Yeah, of course there is. But you need to use, start with like horizontals basically, and then you can do like Fibonacci's and stuff like that, and then you can kind of go from there. So essentially, if you were looking to figure out where is this asset going to go when it does top out, where is it going to pull back to, you would go all the way to the top, and then you would look for targets of confluence. So it might come down to the 236 at 240. It might come down to the 382 at $1.60. It might come down to the 0.5 at $1.19 if it retraces this whole entire situation. But that's not necessarily what's going to happen. And that's why it's important that we just pay attention to that, because you just miss out on all these gains thinking, oh, it's topped out, it's going to go down. I should have bought. And then it tops out and you go, oh, I'm glad I didn't buy. I knew it. And then it comes down and you go, oh, I should have bought. And then, oh, it comes back down and tops out. And then what are you going to do? I should have bought. And that's exactly what it is. So now if you want to predict into the future based on these same Fibonacci's and find a way that you can see where this asset is, what we'll do is we'll wait for the retracement. So let's say this sold off and it came all the way down to the 0.5. Which the more bullish an asset is, the less of a retracement it will have, like percentage-wise, dollar-wise, etc. So let's just say it sold back off like fairly violently, and we got a 3-wave correction, and we came back down to that previous high right there. Oh, whoops, I hit the 5-waver. Sorry about that. Oh, wait, did I do... Sorry about that. Anyway, so let's say we topped out right here and we get a 3-wave correction. So we come down here 1, 2, and then 3. Or it could be anything. I mean, it might be 1, 2, 3. Whatever it is, regardless, the fact of the matter is, what we're looking for is after that correction, we're looking to enter off of these key fib levels and then expect continuation to the upside. Because the likelihood of all of a sudden this being the end of the actual trend on the macro, because we're in a macro bull run, is very unlikely, because it's going to continue making all-time highs until it doesn't. All-time high, all-time high, all-time high. What's next? All-time high. Until what? Until it's not. So we're going to assume the trend continues until it doesn't, because it's only going to switch from an uptrend to a downtrend one time. And it's only going to switch from a downtrend to an uptrend one time on the macro. So the idea is that you're buying into strength always. So let's say we buy into this and then we start continuing to the upside. How are we going to know? Let's say this is our retracement. We get it back to that key support and our previous high, access support, and then we're going to get continuation. So now what we want to do is we want to take our fibs, but we want to do the actual fib retracement and see where we can project out potential targets into the future. So we're going to take from the top to, and now again, this is assuming that this is where our retracement goes to. We don't know for sure that's where it's going to go to. We also don't know that this is going to top out right here. So we have to be dynamic with these targets. But assuming that we started selling off, and then, we put in a lower high or whatever, that we would assume at some point in time A, B, C correction, and then we're going to continue to the upside. So in order to get upside targets, you'll take from the top to the bottom of the corrective wave, and then once that's done, we're going to zoom out and we're going to look at the targets that it puts into place for us. So in this case, it's going to put, I have the 1.382, the 1.5, and the 1.618 showing right here. So, and then there's other targets way up here too. So what you would expect is once this retracement is done, it's going to come back up to 100% of the previous price because it's in an uptrend. So it's going to go down, but then it's eventually going to return to the same spot. So here we are, we go down, but we eventually return to the same spot, and then we go up a little higher. Okay, so then say we topped out right here, we go down, we would eventually return to the same spot, and then we go a little higher. So now we have targets into the future based on those same Fibonacci levels. So now can we do that based on what previously happened here? Of course, let's do that and see if these would have been accurate. Okay, and I have not done this yet, so we'll see where it's going to say that we're topping out at. Actually, I'm going to get rid of a little bit of this because it's just a little too crazy. All right, so now we have essentially, oh, I think I got rid of the wrong one. Here, actually, yeah, I'm going to leave everything else on here, but just go from here. So here, so we topped out right here. That was our previous one, and then we bottomed right here. So we're just going to draw our fib from the top to the bottom. That's our retracement, and then it will give us targets. So where is this saying, based on that previous fib, that we're likely to top out at? The 1.382 is at $6.68. The 1.5 is at $7.87. The 1.618 is at $9.40. These are common retraces to the upside or extensions to the upside. The 2.682 is at $35.75. And these are legitimate actual targets based on Fibonacci confluence and zones. So it's not just me saying like, oh, Bitcoin's going to go to 1 million. Like, these are real targets that are measurable and repeatable. So it's very important that we pay attention to that. And now let's see on this previous one, just to see, because this is going to give us a better idea. I'm going to get rid of just a couple extra of these so it's just a little less convoluted. So we topped out right here, and when we came down, where did we come down to? That's our bottom right there. So now where did it project our target to? So remember, this was the wave that we came down, and then it projected our targets up here. And where were our projections? The 1.382, it stopped, retraced, and kept going. The 1.5, it kept going. And then the 618 rather, kept going slightly. But it went up to those targets, the fib extension targets. And then if you look at the previous, the 2.682 of that previous wave is up here, or 2.618 is at $8.76. So there's a high likelihood that we can make it up there to that level after we broke through these previous fib extension levels. I don't think it's unrealistic that we're going to make it up to $8 or $9 off of this. All right, so now let's do that one more time, but let's do it from our initial point right here, sell-off. And I have a feeling that it's going to be one of our confluence levels of the fib extensions, okay? So we're just drawing from the bottom. And you're supposed to really draw from the bottom point, top point to the bottom point right here. But I spread it out so that it's spread across the chart, and I can see the levels of confluence along the way. I can see when it bumps its head on the target. But in all reality, you're supposed to draw Fibonacci's like this, from the top to the bottom, and then it puts the level there. But I like to have them out like this so I can see how it's interacted with price action along the way. So, okay, so there we have it. Let's see where our fib targets are at. So look at that. Wow. So from our initial sell-off right here, what did we do? We came all the way back up to the 100%. We got back to where we were at, and then we sold back off. And then we finally pushed back up, and we made it exactly to the 1.382. Exactly to the wick, and then sold off. And when we sold off, where did we find support? At the 618 of the entire move. Wow, that's weird. And then when we bounce from there, where we go back up to, the 1.382, put in a new high, and where are we headed to? We're either going to go to the 1.5, the 1.618, or we're going to continue up to the 2.618. And where is that? $37.50. So I'm not saying it's necessarily going to get there. We could top out at any time. We could basically, if we were going to double top, we could have done it now. But this could turn into a massive wick and we could sell off, and that's a double top and that's it. But the truth is, when you look at this chart right here and you start using Fibonacci's and fib extensions and knowing that you're in an uptrend versus a downtrend, which one of those charts would you rather have your money in? Because me, I'd rather have it right darn here. And now let's look at one more thing. I just want to do a quick pattern and then I'm going to get out of here. This was a key resistance level. And when we broke through that resistance, well, first off, what pattern is this forming? We have a flat top and we're consistently putting in higher lows. It's an ascending triangle. So we bump our head, somebody sells because they got into it, they sell at break even, and we sell back off. We come up, we don't make it as high. Find support here finally, keep coming up, we bump our head, and somebody else sells into it and goes, I'm not going to make that mistake again. I should have sold at break even. And then what happens? We put in another lower high, or a higher low. And then finally we bump our head, and then what? It sells back off, but this time it pumps straight through it. So now we break out of the ascending triangle. So what does that mean? We're going to take the meat of the pattern, and then that's going to give us our measured move to the upside for that triangle. So now we're using the measure move of the triangle to see where that's going to put us at. And you'll see as I move it up on the chart, because I'm in log sale, it's showing percentages versus dollars. So as we get higher up, it looks like it's shrinking, but really it's just because how like the log scale like affects the way it looks. So essentially now we have our target, and what did we do? We made our measured move target to the upside slightly higher, and then we sold back off. And when we sold off, we failed to find support at that. So we had, this was resistance, and then we failed to find support. But we were able to find, as soon as that happened, people got scared and sold into it. But look higher low, or low, higher low, higher low, higher low. We're still in an uptrend. So even with that massive sell-off, we're still in an uptrend. So you don't even lose faith in this project or in this asset. And then look, it keeps going up here. We're broken out of this. Now, where would I expect this would have, found support? I would have expected it to find support right here. But that was also a crazy time in the markets and everything. So, that's exactly what happened. We didn't find support. We found it lower, but we still maintained the uptrend. And that's the most important thing. So now when we come up here and we put in a lower high, people were probably expecting it was going to sell back off and hoping it would find support right here. But it was so bullish it got front run, so we couldn't even come down that low, and then immediately it started taking off again. So essentially, we're confirmed in an uptrend. We're still moving to the upside. There's no reason to think that all of a sudden this is just going to be the top. Based on fib extensions and everything, we could top out temporarily, but when we sell off, what's it going to do? It's going to sell back off and find support at a higher low and continue on until it doesn't. And it's only going to break that uptrend and switch around to a downtrend on the macro one time. So all you have to do is just not get wrecked one time on this thing when it sells off, and you're in a better shape. As where with Cardano or something that's in a constant like dead heartbeat, like forever going down flat line, it's the opposite. You're trying the whole time. Every time you try to dollar cost into that thing, you're trying to pick the bottom. And if you say, I'm not going to buy into this because it's on an uptrend and I don't want to get wrecked, you're trying to pick the top. And that's the two hardest things to do ever, is to pick the tops and the bottoms. So if you're going to do it, you better be using Fibonacci or Fibonacci extensions, because that's going to give you legitimate, mathematical, repeatable targets. Okay? And there we have it, guys. I hope that's it's a lot of info. I'm laying it out there. Watch this video as many times as you have to. I'll make it again sometime in the future. I'll address specific points people have. This video was specifically at the request, or, at the realizing that there was a necessity for something like this over just regular old TA. So today, what did we determine? We determined you want to be buying into strength, selling into weakness. You want to be dollar cost averaging up into an uptrend versus dollar cost averaging down into a downtrend. You want to have maximum exposure in an uptrend. You want to have minimum exposure in a downtrend. All right? And there's plenty of other things that we proved in this video, and I didn't do this ahead of time. This wasn't planned. Fibonacci targets have played out. Fibonacci extensions have played out, and just with like 5 or 6 lines on the chart, we can easily see where we would expect to find support. We can then make trades and trade setups based on that, and we have measurable areas that we can set our stop losses and measurable moves that we can measure our risk to reward ratio to see, is this a profitable trade or is it a coin flip? And then when we take all that into account, and then on top of that, we couple in our indicator oscillator, like all our other advantages, we now have, let's say, even a 60% chance of winning. Let's say 70% chance of winning. If every time you flip that coin and it's a 50% chance of winning, but the risk reward on the trade is 3 to 1, every time you're right, you make $3. Every time I'm right, I make 1. So if we make 10 trades and we both win 5, you have $15 of my money and I have $5 of your money. So you are substantially up. Now that's at 50-50. That's a coin flip with good odds, okay? So now if you take the same odds, if you take 1-to-1 ratio, which is even odds, but you take an advantage, so now you win more often than me. So now let's say you win 2 out of every 3 coin flips, but we get the same amount of money each time. If we flip the coin 10 times, you're going to win 6.6 of those. So you're going to have, let's say 6. You're going to have $6 of my money because you win $1 every time, I win $1 every time, and I'm going to have $4 of your money. So you still have $6 now of my money. I have $4 of your money, so you have $2 more of my money than I had. So I lost and you won. Now let's take those two principles and put them together, and that's what we look for with the trade setup. We look for an advantage in the market, which is a higher than 50% likelihood to win, and that's our edge. That's our indicators, our oscillators, our support, our resistance, all of our knowledge that we use, technicals. And now let's take into account risk reward. And that is saying that you're going to win higher than that 50%. Or I'm sorry, that's saying that every time you win, you're going to get a larger chunk of the pot than I get. So now if we couple those two things together, if you can get a, let's say those exact same examples, if you take 3-to-1 trades, 3-to-1 risk reward, and you have a 60% chance of winning like we just used, you're winning 6 out of 10 trades. Look at what happens now. You win 6 trades and you make $3 per trade from me. So you are up $18. And I win 4 trades, but I only get $1 from you each time. I'm down, or I'm up $4 of your money. But then when we take the net, you netted 18 minus the 4 you lost to me. So you're net up $14 and I'm net down $14. And that is what the whole game is all about. It's taking high likelihood chances of success with a higher risk reward ratio. And when I say risk reward ratio, the risk is the little number and the reward is the big number. So you're risking $1 to make $3 in the trade. Versus, it sounds inverse to how it is, but that's how it works. So, well, there you have it, guys. Crypto trend trader, no actual TA. Well, kind of there's some TA in the targets. You can see where the targets are. Don't get all moon boy-y and be like, oh, $32 Tezos, we're going to the moon. Okay, maybe we do. Okay, maybe we don't. Maybe Cardano doesn't go down anymore and puts in a new high. Maybe it doesn't. But do you want to trade with the trend, or do you want to try to pick the bottom? You want to trade with the trend, or you want to try to pick the top? Do you want to allocate your capital somewhere where you are consistently winning because it's an uptrend, even if you suffer drawdown? Or do you want to allocate your capital somewhere where you're consistently losing because it's a downtrend, even if one day it bottoms out and it gets back to new highs? Nah, I'm good. I'm buying strength. I'm selling weakness. Okay? If I had an infinite amount of money, yeah, okay, cool. I want to collect every baseball card out there. Awesome. Every comic book first edition out there. Awesome. By all means, do it. You got unlimited capital. I don't have unlimited capital. Most people don't have unlimited capital. We're not the Federal Reserve. So we have to pay attention to where we allocate that capital. And if you want to be a good allocator of capital, a good capital allocator, one of the best, if you want to be smart with where you put your money after you work your ass off to get it, you better put it somewhere smart, because there's two ways you can lose. One is by losing actual money and making a bad, investment or whatever, and it's going down. But the other way is, what if it just goes sideways forever? What if it just goes sideways forever and that money's just sitting there? That's poor allocation of capital. Because while Cardano is going down for the last how many years, guess who's going up the whole time? Papa Tezos, okay? So buying the strength, selling a weakness, crypto trend trader. Feel free to make donations if I just blew your damn mind. And if you're part of the group, I love you guys. We're crushing it. Thanks for the idea. I would have never even thought to make this video had we not been talking about some of the things we've been talking about. So let's roll, baby. We're doing it together forever. Crypto trend trader, and I'm out.